Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Dan Oliver back on the show with me today. And I'm really thankful to Dan for being willing and able to come on my show on a very short notice, because just yesterday I learned that Dr. Benjamin Weicker had fallen ill and would not be able to come on the show. So we certainly wish Dr. Weicker a quick recovery and hope to have him on the show in the future sometime. But really, we're very pleased and very privileged to have Dan with us today. He is the managing director of Mermican Capital. He was previously involved with Berrien Capital LLC, and he's been around for a few years. I've learned to know Dan as a real honest, hard money advocate, a free market advocate, and for sure, I think understands the markets and what really drives them as well as anybody we have on this show. So thanks, Dan, for coming on again.
Well, thanks for having me.
Really like to talk to you about your August 16th missive titled The First Cockroach. Well, it's certainly an interesting title, although cockroaches are not something that we like too much here in New York City. They're very common, but we hope the cockroaches you're talking about, which refer to the market, to the equity market, or I guess to the financial markets, the credit markets around the world, we would rather not see them appear at all anytime. But by your article, it seems as though you're a little bit concerned we may be seeing the first of some cockroaches, meaning first problems potentially for this credit cycle. Do I have that right?
Yeah, well, living in New York, you know that what they say is when you see one cockroach, there's never just one.
Right.
It's the first one you see.
Yeah.
There are millions more on the walls. And that's the point. If you look back at the 19th century and this century, when we have good records about credit bubbles and their collapse, to go back to what happens, the way a bubble gets produced is the banks produce credit, and everyone takes their credit and goes out and buys assets, which pushes asset prices up, which is the same thing as saying you're pushing discount rates down, right? All an asset is the value of its discounted future cash flows. So as the price goes up, the discount rate goes down. And what happens is, as it happens to senior investments first in the money centers in traditional investments, all of a sudden people discover that they can't, they're not getting the yield they need, that they expect to live on, that the market should give them. And so this is the stated policy of the Federal Reserve. Bernanke came out and said, that the low rates were meant to push people out of treasuries and stocks and into these riskier assets. And that's what they do. They go in, they buy subprime auto, or they buy subprime real estate, or historically, what they do is they go to funny jurisdictions like Argentina and Turkey, places like that, where you get much, much higher yields. And, of course, yields are higher because it's riskier. But that's why capital flows there, because it's pushed, not because it wants to go there, it's because it's pushed out of the money centers by the central banks and by the banking system itself. And then what happens is you find these third world countries showered with all this capital. This is great. And what did Turkey do? It went out and started building shopping malls and big office towers, all these glorious things that analysts like to see and that the local elite likes, but none of them are very productive. These are all consumption items. And so you don't get cash flow returns on those investments. And that's the problem. All of a sudden now, you've invested in these countries, you're not going to cash your need, and then they blow up first. And that's, again, you can trace this back well in the 19th century. A lot of the panics that England experienced would occur first in Argentina, which was their frontier, all the commodities down there, and then it would creep back towards the center. And so what we're seeing is, as the Fed raises rates, nobody cares in the developed markets yet, but the emerging markets are having terrible problems because they can't refinance this thing. I was struck by, you can go to the Federal Reserve website, Jay, and they actually have a data series of the dollar to Turkish lira exchange rate going back well into the 70s and 60s. What's incredible about it is, whatever scale you look at it, it's a perfect parabola. Right? I mean, in other words, the Turkish lira just hyperinflates all the time, except really for the last 10 years, when the European experiment, all the European banks were funding Turkey because it's next to Europe, with all this capital. So you had this moment of stability that was being underwritten by all this capital flow from Europe and the U.S. into places like this. And all of a sudden now we're reverting to the historical pattern that these places are consume capital or death for capital, and they blow up. And then what happens is, when the currencies start cratering, which is what happened, of course, in the Asian crisis of 97 and other time in history, and happening now, is the capital, once there gets eviscerated, right? You're stuck. You own this shopping mall. that the rents are payable in Turkish lira. Well, that's not worth anything anymore. And so then the Turkish banks blow up, and then the European banks that lent the money to the Turkish banks blow up. And so that's the transmission mechanism back to the center, and especially in Europe where the banking systems, as you know, especially in Italy, places like that, Spain, are already chock-a block full of their own malinvestments. And now they got to add the Turkish ones on top of that. And so, but one of the things I've been talking about on your show and elsewhere for a long, long time is when the Fed starts raising rates, and again, there's data on this going back hundreds of years, no one cares until all of a sudden someone tips over. In 2007, it was a couple internal hedge funds and Bear Stearns, right? Someone's wrong-footed or someone's too levered, and they blow up, and everyone says, "Oh, it doesn't matter." No one cared about the Bear Stearns funds, right? It was either Bear Stearns bailed them out. I mean, it was the headline, but who really cares? But then the next one comes, and the next one comes, the next cockroach comes, right? And then all of a sudden you realize the whole cupboard's full of them. And then the system locks up all of a sudden. I read something today I'd forgotten about, which was that when the Thai baht blew up in the 97 crisis in July, the U.S. markets didn't have their mini crash until October, right? It took a few months for that blow to reach our shores. And then what's interesting is, as you may recall, Greenspan had started raising rates subtly to try to constrain the internet bubble, and when the Asian crisis hit and long-term management hit, he lowered rates suddenly, right? And that's what created the big last spike into the 2000 internet bubble before that collapsed. But the difference now is that the Fed has a tightening stance. So again, in a normal environment, I say that quote unquote there has been really no normal environment since 1913, but let's just pretend for a second. Seeing all these problems, the Fed might start getting nervous and maybe getting ready to ease conditions to prevent the contagion from these credit periphery back to the center. But the problem is that they have telegraphed, and they're very much of a mind to tighten, and they're doing it because inflation is running a little hot. Asset markets are still very hot. So they say, well, gee, domestically, we got these problems. We need higher interest rates. But all it's going to do is exacerbate the problems in the credit periphery, which are going to hit the center. I don't know if it takes a few months or a year. I mean, each episode is slightly different, but for sure it will, and it does it because the high rates tip over malinvestments, and obviously the weaker ones go first, and the more solid ones go last. So that's where we're headed.
Yeah. Well, it's. I mean, if you're, I guess, Turkey's borrowing U.S. dollars or European money, the euro, and their currency is going down dramatically. U.S. interest rates going up. So if you're a borrower in Turkey, you're in pretty bad shape now. All of a sudden, in terms of your own currency, you're in a lot of hurt. You're in a bad shape.
Oh yeah, and something happened, Jay, in Eastern Europe. Before the 2008 crisis, they were all taking mortgages out in Swiss franc terms because Swiss franc interest rates were so low. So it made a lot of sense to do it for a few years. And all of a sudden, their currencies devalued against the Swiss franc. The Swiss franc are really strong, and it's the same situation. Now you can't possibly pay your debt back because your currency is so cheap compared to the currency you owe the debt in. Yeah. It's the same story.
Yeah. Well, it seems, I guess, from what we hear anyway, President Trump is putting some pressure on Jerome Powell to ease up a bit. I mean, he's always, I think, has made it be known from the start that he wasn't interested in a strong dollar for his trade reasons, wanting to restore some manufacturing or get some jobs back into America. I think he'd rather see a weak dollar, at least. Do you think? Do you see that him having some? To what extent? I guess my question is, to what extent does the president have anything to say about what the Fed does? Do you think Jerome Powell will listen to him, or which way do you think he'll swing?
Yeah, I mean, so it's a good question. I mean, officially, the Fed is independent, so Trump can rant and rave all he wants, and Powell can do what he wants.
Yeah.
Unofficially, what happens is, again, looking at through the archives of the Fed and reading the history books, is the politicians can put tremendous pressure on the Fed because Congress, anytime it wants to, can change the law, change the rules to start making monetary policy on their own, and the Fed jealously guards its independence. Right now, it's just Trump, so I think Powell can safely ignore him. What he can't do is if the U.S. starts having problems and you start getting congressmen making noises and all of a sudden Trump has support in Congress to do something with the Fed, that would really spook them. and they would respond to that. I mean, you may remember, when Volcker jacked rates up, there were impeachment threats and all kinds of things. It was only because Reagan stood with him that he was able to withstand the pressure from Congress. Mm-hmm. We don't have that pressure right now because the U.S. is still doing well, but don't think for a moment that pressure won't come the moment that the markets start falling mm-hmm. apart. And then I think the Fed will find itself in big trouble. I mean, again, Jay, we know what they're going to do, right? We know.
Yeah, we know what they're going to do.
The U.S. market falls apart, they're going to print like crazy. And the point of my letter was that the longer you delay intervening in these markets, right, the more you have to intervene. I mean, the harder it is to get a spinning top going again. And so the problem we're facing now, the problem the Fed's facing, is that they're stuck on this tightening routine when the rest of the market's falling apart, which means that when it hits the U.S., they're going to have to take extreme actions to keep U.S. markets from falling apart. I'm actually kind of excited about this, Jay, because if this is what we've been waiting for us for 10 years, right? Since 2008, it looked like the world was coming to an end, and normally in credit collapses of that magnitude, like in 29 or go back to 1874 or 1837, places like that, the whole system blows up or collapses, and you start from scratch. And Bernanke, to his credit, managed to reblow a bigger bubble. And that's something that the gold investors did not expect. I think a lot of the traditional guys didn't expect it either, but he did it. But the result is now the bill is coming due for that, and the bill will be bigger now than it was in 2007. And this is the moment when the system starts wobbling, and it's a more unstable system now than it was 10 years ago. I think that gold is really going to have a much bigger move now than it would have had back then had the system collapsed.
All right. Well, the last time, 2008, 2009, gold got hit really hard along with everything else. I think when the margin clerk calls, you have to sell what you're able to sell. There's always a bid for gold. There's always a bid for gold. Gold was taken down. Silver was taken down along with everything else, but it didn't stay down long. Gold rallied and then eventually, hit 1900 by 2011. And so what are your thoughts this time? I mean, we're likely to see more cockroaches coming out, as you say. There's one. There's not just one. There's millions. There's lots of them. You look at Brazil, Russia, South Africa, China. For goodness sakes, China. I saw sometime recently they borrowed something like $2 trillion offshore, U.S. dollars offshore, and then have lent them onshore to Chinese interests. I can't imagine, that's got to be easy for China to repay either. If the dollar continues to show the strength it's shown recently. So I guess my question is, what do you see happening? Are we likely to see the same thing happen again? The margin clerk calls, gold gets hammered down really hard with everybody. If that's the case, then hold some dry powder so you can pick up some more gold and some more gold shares before the big rally comes.
So, Joe, I've been very agnostic about that question because I think there are different factors involved. You're absolutely right. In 2008, you had a momentum trade in gold. Remember, gold had gone up almost parabolically from the bottom, and so a lot of guys were in that trade, levered up, and then the crisis hit the U.S. first. Don't forget, it hit the first world first with real estate, and so all the margin calls went out, and all those momentum traders were thrown off, and anyone unlevered in the COMEX was sold out, and that's what drove that liquidation. And then, of course, as you point out, and the moment that was done, gold took off like a rocket once that selling was done. This is different because I don't think there are a lot of Western speculators levered up in the gold trade. We did momentum trade, certainly, and if anything, these spec traders short gold. So when the market clears calls, they're not going to buy it. I think what's happening now is if you get out of the first world and go to a place like Turkey and China, a lot of private loans are backed by gold collateral. And so when you default on your loan, your lender takes your gold, and he's got to sell it because he's got his own obligations to meet. Mm-hmm. And Dennis Gartman had something in his letter this morning that apparently the Turkish central bank's gold position went from over 500 tons 3 months ago to over 200 tons today. So they've gotten rid of 300 tons of gold just in 3 months to defend their currency now. Apparently, I've read commentary that they count as gold on their balance sheet Turkish commercial bank deposits, and so it may just be the gold move from the central bank back to the commercial banks. But either way, it's showing you that there's a lot of credit stress, and that gold is very involved in that stress. And so I think what's happening now is it's not margin-driven liquidity selling. It's collateral selling in the East that's driving it, because that's where the problems are happening first this time. But again, that will burn itself out. And what's I think very bullish is that the stance of Western traders is so bearish. And so once gold gets a bid, once that dynamic plays out, gold is going to go a lot higher. I mean, again, it's hard to imagine that having Turkey descend into maybe not hyperinflation, Venezuela style, but a serious bout of inflation is going to be net negative for gold, or any other country for that matter. So I don't think that this is going to last for very long. I think once gold frees itself that dynamic, and you have this enormous spec short position in gold in Western markets, that you could really see it go on a tear.
Well, Michael Oliver, who is on with us the first segment, is looking, he believes that the T-bond has broken down, that we're in for much higher rates, and he's looking for a 4%, I believe, if I remember right from a few minutes ago. He's looking for 4% on the T-bond. What would that do? What do you think rates like that would do to this current market environment?
Yeah, I love that question, because I have such a heterodox view on it, and that is, again, to the extent that there's a huge offshore dollar debts, higher interest rates, the first order effect is to strengthen the dollar, right? Because there's $10 trillion of offshore debt. Forget about the onshore debt, right? And if you have dollar debt and rates go up, you need to hold more dollars on hand to meet your interest payments, or that's your collateral. And so there's a big short squeeze on dollars. The longer-term effect of that is that if you look at the Fed's balance sheet, it has gold on it. It's got 7% of its current assets are gold at current market prices, and then 93% are very long-term bonds, and long-term bonds are very sensitive to interest rates. So as rates go up, those things devalue. And when you look at the gold price versus the nominal interest rate in the 1970s, look at a graph superimposed. It's a perfect match. As rates went up, the bonds got crushed in the Fed's balance sheet, and gold went up to compensate for that. So I think the short-term effect is the strong draw. The more longer-term, more powerful effect is a huge gold bull market that we've all been waiting for.
All right, Dan, we have to leave it go at that. We're out of time. Thank you so much for sharing your insights with us. Greatly appreciated.